Risk-sensitive currencies are down after the EU warned Trump's 30% tariffs on exports would stop trade across the Atlantic. Elsewhere, China reports better than expected exports, while Singapore's GDP outperforms. That's coming up in our 5 Things in 5 Minutes on Tuesday, July the 15th. And then in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes explains why metals prices for batteries have slumped so much.
Absolutely, and these things can happen particularly in relatively immature sort of markets which are developing quickly, and certainly the battery metal market really didn't exist a decade ago.
But first, in 5 and 5 with ANZ, the European Union has warned that Donald Trump's threatened 30% tariffs from August the 1st would shut down transatlantic trade dead, according to ANZ economist Bansi Madhavani.
EU Trade Commissioner Sefcovic said that 30% tariff by the US is unacceptable and it is prohibitive to any kind of trade. What reports are suggesting is that the EU is consulting member states to prepare a coordinated response if higher tariffs do come through, but they maintain that retaliation is not their preferred way of engaging and they would still prefer to get a deal done ahead of the 1st August deadline. Mexico has also said something similar. They are hoping to reach an agreement, and they have added that they do have a plan in place if no deal is reached by 1st of August.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.2%. The 10-year US Treasury yield flat at 4.42%. Gold fell 0.2% to $3,359 US an ounce. West Texas Intermediate futures fell 2.2% to $66.96 US a barrel. The US dollar index rose 0.2%, and those risk-sensitive currencies, the Aussie fell 0.4% overnight to 65.49 US cents, and the Kiwi fell 0.5% to 59.77 US cents. The euro also down around 0.3% against the US dollar. Number 2. Bansi says markets will focus tonight on US CPI data for June, with core inflation expected to have risen around 0.3% for the month from May.
We are expecting that June's CPI data will show some of the increased tariff-based cost pressures which businesses are facing that gets passed on to the consumers. Where could we likely see it? It's likely to reflect in prices for components like apparel, new cars, given that they are highly sensitive to tariff prices. If the June CPI inflation data are indeed weak, there is a slight possibility that the Fed flags that rate cuts were discussed and considered at its meeting coming up at month end. But our baseline view is that the Fed will continue watching data and say that it needs more information for it to be able to cut. We still think that the earliest the Fed can cut in this cycle is at its September meeting.
China's exports rose 5.8% in June, which was stronger than expected. Here's ANZ's Asia economist Vicky Xiao-Zhou with analysis of the results.
We saw the strong June number, which still have some residual impact of the front-loading activity. But for the second half of the year, we expect the export to slow down. Also, given the high base last year, China's export growth year on year will enter into a downturn of the cycle. On the other hand, the low base last year will lift the import growth in the second half of the year. We expect the net export to GDP growth is going to slow down.
Number 4. Singapore's GDP grew 1.4% in the June quarter and was up 4.3% from a year ago. That was a lot stronger than the market consensus. ANZ Head of Asia Research, Koon Goh, explains why Singapore's GDP was so strong.
Singapore managed to avoid a technical recession after the surprise contraction in the first quarter. The economy rebounded very strongly in the second quarter, up 1.4% quarter on quarter. And for the year on year, it was up 4.3%. That was a lot stronger than what the market consensus was expecting. And part of the strength, I guess, is down to front-loading activity of exports and also increased public construction activity, which helped to boost the construction sector GDP.
New Zealand's services sector contracted again in June after a big contraction in May. ANZ economist Matt Galt explains what it means.
It adds to the wider picture of the New Zealand economy stalling over Q2, with the PMI out on Friday in a similar range, around 48. And more generally, activity indicators have been quite soft across the high-frequency indicators for New Zealand.
Matt Galt there. Now, in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes explains why metals prices for batteries have slumped so much. I asked him whether this was a perfect storm.
Absolutely. And these things can happen, particularly in relatively immature sort of markets, which are developing quickly. And certainly the battery metal market really didn't exist a decade ago. So it's been quite a phenomenal sort of period of growth. And we get these periods of dislocation. The issue I think that we're facing now, though, is the levels or the volumes, I suppose, being consumed are getting quite large, particularly in China. And these periods where prices do come off result in a bit of, I suppose, strategic hoarding, I suppose, by key consumers such as China. And we've certainly seen imports for a lot of key critical minerals, particularly though lithium, cobalt and nickel, hold up pretty well despite that sort of slower growth coming through on demand. So it does appear that China is really stockpiling for the future.
Yeah. There's also the issue of a price war in China, which has certainly shaken things up there. Could you tell us a bit more about that and how that's affecting demand for these battery metals?
Yeah, well, I mean, prices for EV cars in China have been falling for some time, but certainly with the amount of new models, new manufacturers coming online, the ability to reduce unit costs really is driven by size or market share. And that has obviously opened up a bit of a price war within that market in China, which has pretty important implications for the battery metal market. In general, the manufacturers will tend to really apply pressure on the suppliers of those metals to lower prices or costs in some of the direct dealings they have. It also means that they really are becoming more thrifty around the use of their materials, and we can see sometimes a little bit of chemical changes, I suppose, in the composition of those batteries, which results in a bit of fluctuation, I suppose, in the demand for those. But certainly that ongoing sort of destocking, restocking phase within the battery market in China means that the raw material markets can become quite unstable.
And just finally, how are the producers responding to this drop in prices in terms of their plans for new projects or expanding supply from existing projects?
Yeah, well, we certainly have seen some reaction. I mean, the producers in some key markets, particularly here in Australia, we've seen some projects put on the back burner or others in current operations put into sort of care and maintenance. So there has been a bit of a reaction from the market. Clearly, at least in the shorter term, that's not really making a huge difference in that sort of oversupplied situation a lot of them find themselves in. But it is a difficult issue over the medium to longer term, because certainly all sort of projections of demand over the 10 to 20 year sort of time frame point to a significant increase in demand. So ultimately those projects will be needed. But in the meantime, the economics with where prices are just don't stack up in a lot of cases. So we'll continue to see the supply side react by pulling supply off the market.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, July the 15th. Catch you tomorrow with reaction and analysis on those US CPI figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.